Hello everyone. Today's Friday, February 7. Let's take a closer look at the charts for the euro and the British pound and assess potential market movements. Starting with the euro, the currency faced downward pressure in early trade yesterday, weighing down by Wednesday's weak retail sales data. Later in the day, the euro regained some strength. Traders received data on US initial jobless claims, which came in slightly above expectations. Against this backdrop, the dollar failed to gain much ground against the European currency. In addition, dovish comments from Federal Reserve officials Christopher Waller and Mary Daly contributed to a weaker US dollar, providing further support for the euro. Turning to the British pound, it dipped sharply, briefly losing more than 150 pips. Sterling came under pressure in early trade, which then intensified after the Bank of England lowered interest rates and reported its economic predictions. The regulator halved its GDP growth forecast for 2025 to just 0.75%, with Governor Andrew Bailey emphasizing the need for further economic stimulus. Despite growing concerns about potentially inflationary pressures, Bailey indicated that additional rate cuts remained on the table. The Bank of England forecast that consumer price inflation will peak at 3.7% by the end of the year, up from the 2.8% projected in November 2024. The bank also anticipates wage growth of 3.7% in 2025, which could further fuel inflation. Meanwhile, the regulator remains focused on stimulating economic growth, leaving the pound sterling poised to react variably to the upcoming data. Given the prevailing uncertainty, traders should closely monitor US dollar movements for guidance. Now, let's take a look at today's macroeconomic calendar. It includes data on Germany trade balance and industrial production for December 2024. France will also provide updates on private non-farm payrolls and its trade balance. In addition, Bank of England officials are scheduled to speak today. Positive data from these releases could lift the euro in the first half of the day. The second half of the day will shift focus to US labor market figures. Non-farm payrolls are expected to have increased by just 169,000 in January, down from 256,000 in December. The unemployment rate is projected to hold steady at 4.1%. If the figures align with analyst expectations, the dollar may weaken, potentially benefiting risky assets and allowing them to recover from losses incurred early this week. Furthermore, the University of Michigan is set to release its reading on consumer sentiment, inflation expectations, and current conditions. What is more, traders may take notice of speeches by Federal Reserve officials for any hints regarding future policy actions. In the meantime, the dovish tone from many policymakers emphasizing the need for further monetary easing continues to prevent the greenback from gaining significant momentum against both the euro and the pound. Turning to technical analysis, the 1-hour EUR USD chart indicates that a decline followed by a false breakout at 1.0355, driven by weak German data, would trigger a buy signal with the euro likely to rise to 1.04. If the price breaks through and consolidates above this level, further gains to 0.440 and possibly 0.468 could follow. At the level of 1.0468, I recommend going short on the rebound, aiming for an intraday correction of 25-30 pips. Short positions at 1.0400 and 0.440 are only valid on a false breakout, with bears looking to regain control of the market and push the price back down to 1.0355. If the price breaks below 0.355, it could pave the way for a move to 1.0318 and even 0.278. At this mark, it would be wise to go long on a rebound, targeting a move of 35-40 pips. Long positions at 0.318 and 0.355 should only be considered on a false breakout. Speaking of the British pound, it recovered some its losses yesterday. Although bulls are still in the market, the Bank of England's stance is waning on the currency, potentially limiting its upside potential. A false breakout at 24.41 would generate a sell signal, with the pound returning to 23.98. If the price breaks through and fixes below this level, sterling would likely extend weakness to 23.61 and possibly 23.24. At this level, traders are advised to go long on a rebound, counting on an intraday correction of 35-40 pips. Going long at 23.61 and 23.98 would only be relevant on the false breakout. The level of 24.41 would be a key target for bulls. Its breakout would open the way to 24.73 and 1.2505, with a pound-dollar pair likely getting stuck in a broader sideways range. At the level of 25.05, I would recommend going short on the rebound, expecting a 25-30p move. Short positions at 1.2473 and 24.41 would only be prudent in the event of a false breakout. Best of luck and have a nice weekend.